Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. Pleased to have Nick DeVito, also a certified financial planner and an equity owner in the business. Thank you for joining me again today.
Thanks for having me.
Doing a case study. Actually, here's the funny part about it, is had a staff meeting the other day because we're talking about someone who called in, and I pulled the staff together and said, hey, look at this one. This was pretty cool. And then somebody in the office says, why don't you make this an episode?
Yeah.
I'm like, dude, that's an awesome idea, especially since this particular one touches on cash flow planning, and we never really had an episode on that.
Not that I can think of.
You know, it might have been a little piece of something, but so what we're going to do is a case study. If we get it done in one episode, great. If not, we take it to two. We'll find out soon enough, won't we? So we got a call through our website. Someone did a Google search, called us up and said, look, I really need help with cash flow planning. I'm up to my eyeballs in debt and also want to think about retirement planning. So that was kind of the note that they left. Tried calling, we went back and forth. We ended up having a phone meeting on Saturday. So called him up on Saturday and said, so tell me what's going on. And he said, I'm swimming in debt. We have enormous expenses coming up, and our cash flow, we're choking to death. I said, okay, standard issue. You go to the doctor with an ailment. I would hope that the doctor does a physical. Well, especially since he doesn't know. We don't know them. So I said, all right, talk to me about it. So this is Joe and Susie, names to be changed or have been changed. I said, so tell me what's going on. Always focus on the debt, but really I need to see how it fits into the big picture. So I got to cheat and look at my notes here because I wrote them down here. So Joe is 59. He's married. His wife is 51, and they have two children that are both adult children grown out of the house. All right. So the children aren't an issue. They own a home. It's worth about $500,000. This is assets wise. Joe has a 401k that's over 200 million. Sorry, 2 million. 200 million, he wouldn't have a debt problem.
Yeah.
$2 million in his 401k, which is still pretty nice. He has an old 401k worth about $350,000. Susie has about $200,000 in her 401k. She has a small Roth, but I will point out, Joe being 59, Joe does not have a Roth IRA.
Yep.
Okay? That comes into play later because Joe's 59, Susie's 51.
Yeah. And it's something we always look at when we start to meet with someone. Like Mike said, we like to get an idea of the whole picture. And in particular with the Roth, when they're nearing that age 59 and a half to when they can draw on those retirement accounts, we always want to see when they got that time clock started, if they got that time clock started.
That's correct. That's correct.
And just to clarify, the time clock that I'm referencing is in order to pull money from any retirement account, you need to be age 59 and a half. And with the Roth in particular, if in order to enjoy that tax-free growth that it offers, you need to be age 59 and a half, and the account needs to have been funded for at least 5 years.
Right. So Susie has a Roth, Joe does not, which means Susie's 5-year time clock has been started. When, I don't know, but it didn't matter to me.
Yeah.
Because she's 51.
Exactly.
Okay. Joe didn't have one. It matters to me because he's 59. Mm-hmm. Okay. Will be 59, actually be 59 real soon. So anyway, that's their assets. But most notably, let's talk about their debts because that's what they were talking about. So on their $500,000 house, they have a mortgage for $200,000 at like 3.25%. Nice. Right. Their payment is just shy of $1,300 a month. And they pay escrow separately. Okay, they have their own, they pay their taxes and their insurance separately. They have a home equity loan for $34,000, which was actually a home equity line of credit that hit its maturity. And I think in their case, they said it was at the end of 5 years that it flipped from the line of credit to a fixed loan. So their payment on that is $500 a month, and that's at 7.25%, which suggests to me that it ballooned sometime recently for it to be 7.25.
Yep.
Okay. Then they have credit card debt, revolving credit cards. for $13,000 at roughly 20%. They vary. The different cards are varying. And their payment, the minimum payment's about $300 a month. So just between their home equity loan and their credit cards, it's eating them up at $800 a month. Then she also shared with me that they have $100,000 in student loan debt. And what the student loan debt is for one of their children. And she chose to put the loans in her name.
Yeah, so that's referred to as a Parent Plus loan. That's
Yes.
the way that you can take out a loan on behalf of your child going through school.
Right. And because she works in a hospital that is a nonprofit, she actually could benefit if she works there for at least 10 years. It's considered public service. If she works there for at least 10 years, the balance of that loan is forgiven.
Yeah, and so just a little bit of backdrop on how exactly that works. So if you qualify for that public student loan forgiveness, you need to be in a qualified institution. Usually that's a nonprofit. It could be a hospital. It could be any kind of nonprofit out there as long as it qualifies. And the way it works is if you make 10 years of payments on time and you stay in good order with them, at the end, the balance of your loan gets forgiven. And it's an income-driven repayment plan, so it's based on how much you make. That's how much you're going to be paying towards those loans over the course of those 10 years.
Now, you have to declare that when you first take out the loans. Correct
I
or
don't
no?
think it's when you take out the loans. It's when you begin your payment plan.
Okay.
It's more about when you select that payment plan, because that's when you're going to get on the income-driven repayment plan, and that's going to determine, obviously, what your payment's going to be.
Okay. So they're 2 years in, so they know that they've got 8 more years should she continue to work at that particular job for 8 more years, which that's motivation to stick around. You know what I mean?
I mean, we all know about the golden handcuffs that are out there. I don't know exactly what color these handcuffs are, but they're certainly some type of handcuffs.
That's right. They are. And then what's also hanging over their head is they've got $60,000 in home repairs that, the way they explain, there's no ifs, ands, or buts. These need to be done. They have to replace their septic system at their home and whatever the problems are, but apparently other people in the neighborhood are experiencing the same thing. And they also have $20,000 in other home repairs that need to be done this year. So what they're dealing with is $47,000. Let me back up. $34,000 in a home equity loan, which is costing them close to $500 a month. Then they've got the credit cards, which is costing them close to $300 a month. They didn't say how much their student loans were, but we can't refinance or play with them.
Yeah.
Okay. Not only that, but their student loan interest is relatively low.
Yeah.
Say relatively.
And just to clarify, Mike saying we can't refinance them, they could if they wanted to. It just wouldn't make sense when you're
Right.
on that payment plan because they're going to be forgiven.
Correct. Not only that, but they're also lower interest rate than they would be able to refinance for. And then they got the $60,000 in upcoming home repairs. So we're taking a look at their debt. So basically they've got $800 a month that they're choking on, and they've got this thing hanging over their head of another $60,000 in home repairs. They're like, I have no idea how we're going to pay for this because our cash flow is not allowing for it.
Yep.
Now, from an from an income side, Joe makes about $135,000. Susie makes about $85,000. So making about $220,000 between the two of them. Sounds like a lot of money for people who have cash flow issues, but they're also just getting through putting their 2 kids through college and, supporting them in certain ways and stuff like that. Then I said, all right, well, tell me, are you contributing to your 401k? And Joe said, yeah, I'm contributing 4%. And do you know what your company matches? He says, well, yeah, the company matches. As long as I put in 6%, I'll get the max, or the full match. I'm like, and you're only putting in 4? He goes, yes. I said, well, first things first. This goes against the whole cash flow problem, but we need to fix that. You're leaving money on the table. Okay. So I said, look, the first thing you need to do is you need to switch and bring yourself up. Check with the summary plan description. That is the rule book of 401ks. You want to fill in that?
Yeah, I mean, that's going to have, the summary plan description is going to have absolutely everything you could possibly want to know about your 401k plan. That's going to tell you whether or not you can make traditional Roth after-tax contributions, if there's a loan provision to your plan, what the employer match looks like, vesting schedule for that employer match, anything you could possibly want to know about your 401k is going to be held in that. And furthermore, that's not just for 401ks. You'll have a summary plan description for various benefits you have. If you have restricted stock units, employee stock purchase plans, stock options, anything like that will have a summary plan description associated with it.
Right. So coincidentally, he's now working at the same place that Susie works. So she knows what the benefits are. He didn't really know what they are. Well, he kind of knew, but he knew. He said, well, we're cash flow strapped. Okay. And she said she's 10%. But it was also, she said, well, every year when I get a raise, it goes up. I said, well, wait a minute. Okay. This is no fault of hers for not knowing, but she probably signed up for the plan that either automatically increases by 1% every year, which, by the way, I think it's a great idea to do, because what happens is that it slowly increases your contributions to your 401k automatically. You don't really notice it, and she's sitting at 10%. And I'm like, your cash flow's tight. I said, why don't you back it down to whatever you need it to be?
Yeah, and you'll see that with plans where they might have that auto up feature in there where it's going to auto increase every year. And then usually it is capped, I think, around 10%. It's not going to, typically it won't continue to go on forever. It's not going to get to a point where all of a sudden you blink and you're at 50%.
I've been working for 47 years.
Exactly,
Holy smokes.
Exactly. But yeah, to Mike's point, I mean, you look at that and you say, okay, you're struggling with cash flow, but we want to make sure we're taking advantage of the full match from Joe's side. And if you're over contributing to one and under contributing to the other, that's an easy fix. Let's balance those out a little bit. Reduce Susie's contributions, increase Joe's contributions. And honestly, so Joe really only needs to contribute theoretically 2% more to his to get the full match, and she could contribute 4% less and still maintain that full match. And when we're dealing with people with cash flow issues, oftentimes we'll have them back down to whatever their full match is.
Right.
Okay, let's get you out of this hole. Once we're through this, then we can look at increasing those contributions again.
Correct. And so the other thing that I had noticed when I was gathering the information about their assets is they, like many folks that age, have been in the trap of contributing to the deductible 401k all their lives, not realizing the concept of the phantom taxation of Social Security in retirement, as well as, there's a lot of risks, and they have a lot of pre-tax assets. So I also suggested to them at the same time, I asked them, do you have a Roth 401k option? And they said yes. I said, good, because we're probably going to take advantage of it. All right.
Yeah, and when Mike was presenting it to us, my first thought is, okay, these are people that are very retirement account rich and cash poor, and that's why they're in the predicament that they're in. And what our job is, and what we the angle we took of this is, how do we tap into those retirement assets? How can we utilize all these retirement assets they have available to them to help them get them out of this hole?
Right. And so one of the things that I had thought about, of course, the handyman has a lot of tools in his box. All right. And so one of the things that I was thinking about is like, hey, you know what? Ironically, the home equity loan and their credit cards are to the tune of about $50,000, where $50,000 is the max that you can borrow from
401k.
From 401k. How about that? Imagine that. However, round numbers, $50,000 is going to cost you $1,000 a month.
So it's not helping their cash flow in that specific example. Because that is a great tool sometimes, and we've recommended that people take advantage of that many times, where if you're having issues with debt, especially when you're dealing with credit card debt, that high interest debt, consolidating with the 401k can be a great tool. Not only is it going to lower your interest payment, but hey, instead of the bank getting the interest, you're getting the interest.
Instead of the bank getting 30% interest, I'm getting 6%.
Exactly. So that's a great tool for consolidation. Another thing that my mind instantly went to was, okay, they do have equity in their house. So what about they have the home equity loan? What about a home equity line of credit?
Right.
And that's another great tool that we often will use. It's a great tool that we almost recommend everyone has available to them, just because of the flexibility that a home equity line of credit can afford you. But in their particular instance, it made a lot of sense because we're like, okay, let's look at debt consolidation, and that's a great tool to do that.
So the last little bit that I'm going to talk about the base facts, because then after that, we'll come back after break, and then we'll talk about some of the solutions and strategies. So as I'm going through it, I see what their income is, and I was very quickly able to ascertain that they're in the marginal 22% tax bracket. Okay, that's number one. also, given the amount of pre-tax assets that they have, the odds are very high. And the only reason I'm saying almost certainly is because there's talk about them not taxing Social Security. That's proposed out there. I'm not a believer that it's going to happen, but be that as it may, if the rules remain the same as they've been for 40 years, they're going to unquestionably be in a higher marginal tax bracket in retirement than they are today. Then I pointed out earlier that Joe's not getting a full 401k match, and Susie is over contributing to her 401k relative to the match. So what we're going to do is we're going to come back after break and we'll talk about some of the ideas and strategies and solutions that we came up with. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we are picking up with Joe and Susie, where they have the debt issues, the cash flow, not as much a debt issue. I think it wasn't as bad as I was expecting it, but they have cash flow issues, okay? And we're trying to figure out how are we going to fix this, okay? Well, first of all, what I started talking to them about is right out of the gates, we want to make sure they're not missing company match. So I immediately had Joe, which they knew what it was. He increased his 401k to make sure they were getting full company match. Similarly, for a cash flow perspective, I had Susie drop hers down to whatever that max was, that she's still getting the full company match. Now, because of the fact that they're pre-tax retirement plan rich and Roth IRA poor, and the high likelihood that they're in a higher income tax bracket in retirement, what we did is we said, flip the switch from traditional 401k to Roth 401k. Now, from a cash flow perspective, that's going to hurt him. And I explained, full disclosure, I said, look, what I just did here is going against what you talked to me for about cash flow. I said, but we'll handle this first because this is improving the efficiency of your accounts.
Yeah, and I think when you ran through the numbers, it wasn't as drastic of a difference as you may have expected, because you were bringing him from 4 to 6, you were bringing her down from 10 to 6. Now you are making that switch to Roth, which is going to increase. You're now paying the tax on the contributions that you used to be the deduction for.
Right.
So that's going to reduce your paycheck. But because it was bringing down 4%, bringing up 2%, it wasn't as bad, but it needed to be done, to your point.
Well, needed is a funny word, but
it made sense.
It ended up that we figured that the cash flow difference on a monthly basis is less than $100. So at the end of the day, when they say that their spending costs of living is close to $11,000 a month, I don't want to belittle $100 a month, but for $100 a month to dramatically improve your efficiency, it's worth it.
Exactly.
It's because they're going to save way more than that $100 later on, because now is where we came up with the idea.
And real quick, before we move on to the solution for the debt, one thing I want to touch on too is another thing we talked to them about, or you had talked to them about, was getting that time clock started for Joe for his Roth IRA.
Right.
Which is very important. Earlier in the episode, we said in order to enjoy the tax-free growth that a Roth IRA can provide, you need to have the account be age 59 and a half, and the account needs to be funded for 5 years. In his case, there was no Roth IRA. Now, I know we've mentioned him contributing to a Roth 401k, but there is a rule surrounding that doesn't make sense.
Little known rule.
It's a little known rule. Doesn't make sense, but essentially contributing to a Roth 401k does not start that 5-year time clock as you would think it would.
Right.
So, for example, if you were to be you could be contributing to a Roth 401k for 30 years, you retire, you roll that out into a Roth IRA in retirement, you don't get to enjoy that tax-free growth.
Right.
Because you did not start the time clock in the Roth IRA. So one thing we always have people do, if they don't have that time clock started when they come to us, we usually find a way to get that started, whether that's doing a nominal conversion, whether that's making a contribution. Obviously, there's contribution limits when it comes to making a contribution to a Roth IRA, so you always have to keep that in mind. But always making sure that we get that time clock started so then we can fully take advantage of what the Roth has to offer.
Right. And so, like I like to say to everyone as a disclosure up front, there's one thing I'm a master of, and that's spending other people's money.
Yep.
But what I suggested, to your point, Joe does not have a Roth IRA. And because their income is low enough that it didn't exceed income limitations, he can contribute to a Roth IRA for prior year. Okay, so since this is early 25, it's before April 15th, or at least when we're recording this, is he can contribute to last year, and that's effectively, his time clock started January 1st of 2024.
Yep.
So his 5 years, he can enjoy the tax-free growth and be able to pull the money out January 1st of 2029. So here we're kind of picking away at little things that they could or should do for the big picture, but now we're ready to attack. So consider the idea, as we pointed out earlier in the first segment, we could have done a 401k loan. The 401k loan would have solved the $50,000 in debt, but it would not have solved the cash flow.
It would have actually negatively impacted their cash flow.
That's correct. It would have cost them an extra $200 a month. All right. So not only that, it wouldn't have helped them for the $60,000 that they got coming down the pike.
Exactly.
All right. So what I then suggested, I said, hey, I got an idea here. They have plenty of home equity. So I said, go march down to your bank and open up a home equity line of credit. And they know what one is because they had one that converted into a loan. I said, go down to the bank and try to get the maximum that you can get. So if he has a $500,000 home, assuming the bank's 80% of 500 is 400. 400 minus the 200 they have in their mortgage means that they have $200,000 worth of room. So they can go down to the bank and say, let me have a $200,000 home equity line of credit. To point this out, they're going to look at their income is fine. And they're going to look at their credit, which I asked them, their credit is fine. So they should be able to have no problem getting that line of credit.
The only thing I will add to that is that they do have that home equity loan on their house. So
Right.
what's important to note about that is it's unlikely that a lender is going to want to take the third position on an asset, on the house in particular. So you figure the mortgage is the first tranche there. The second position is going to be that home equity loan, and then that third position would be the home equity line of credit. In order to get that home equity line of credit, you're going to have to go to the lender that has either the first or second position. You're not going to be able to find a new lender. It's very unlikely that you're going to be able to find it.
With one exception. We take the home equity line of credit and pay off the home equty loan.
Yep.
Which is what we're going to do
Yeah.
anyway.
Yeah.
Now, they're going to go to the same credit union they've been using, right? But great point.
Yeah.
So no lender will ever take third position if they're not in the first or second in itself. So we said, look, take out the home equity line of credit. Now you pay off the credit card and the home equity loan. And if it's an interest only, the interest that they would be paying, their minimum monthly payment, I wrote it down here, would have been $300 a month. Whereas they're currently paying $800 a month between those two loans. Just remove the noose around their neck. And they can subsequently take an extra $60,000 out of that line of credit and use it to fund those costs that they have on the home repairs. All in, that $107,000 that they have on that line of credit will cost them less than $700 a month, which is less than the $800 a month that they're currently paying to fund those debts. So what did we do? We just took the home equity line of credit, we paid off that home equity loan, paid off the credit card, and we had it available for that when they needed to do the septic tank repair or replacement, they just grab the 40 grand from the line of credit, poof, and pay it. And then if they had the other repairs, grab the 20 grand from the line of credit, poof, pay it. All by the time they get done with all that, they have a total of $700 a month and breathing room. Because in the event that they needed $1,000 or whatever, because something exceeded, they don't have to have their credit cards run month to month. They could grab it from their line of credit. And I kind of got a sense from them. I'm very skeptical of suggesting a line of credit when people are spenders, but I could tell they're not. Okay, and it's just sort of a soft interview process. Because if you're going to take the line of credit, pay off all your debt, and then run up the debt, that's silly.
And unfortunately, that's something we have run into in the past, because you do have people that get in debt, and we find a way to get them out of that, whether that be whatever form of consolidation that may be, whether that's a 401k loan that we talked about earlier, using a home equity line of credit. And unfortunately, sometimes people will get themselves right back in that hole. And it's very sad to see, and it's difficult when you gave them a way out and they kind of revert back to that old behavior.
I know.
And then just to clarify something, if you're not familiar with exactly how the home equity line of credit works, it's very similar to the credit card in the sense that if you need money from it, you can go and grab it, but it does begin accruing interest the second a credit card doesn't do that, but the second you take money out of that home equity line of credit, you're accruing interest on it daily.
Correct.
And it's most of the time we recommend people get it at the bank they do their regular banking with. That way it's just nice and easy to toggle from your regular bank account to your home equity line of credit and back and forth that way. This works well for anyone. I shouldn't say anyone, but this can be a good strategy for a lot of people to use. But in their particular case, because they were retirement plan rich, he's going to be turning age 59 and a half in this year.
That's right.
Which gives him the access to he has the old 401k lurking out there, gives him access to that. So now when he does turn 59 and a half, takes the money out of the 401k, uses it to pay off the home equity line of credit, and we just wiped out all of his debt.
Exactly. And so, so one of the things that we're going to do, and I'm going to even refine that a little bit more, okay, is it's beautiful that he turns 59 and a half October of this year. You couldn't ask for more. So what we'll do is we could wait until October to do a distribution from the IRA. Call it $100,000. Or we can convert $100,000 from an IRA to a Roth IRA, stick that $100,000 into a guaranteed interest, like a money market or short-term CD or what have you, okay? And then what ends up happening is over the next 6 months, $100,000 at 4%, he's going to earn $2,000 tax-free, okay? And then what he does is he grabs that $100,000 back out, then pays off all of the debt. Okay, leaves the $2,000 of interest in the Roth IRA because that interest wouldn't have gotten a tax-free growth because it hasn't been 5 years yet. But then we also have the ability, because they're in a position where it would be advantageous for them to do Roth conversions anyway. So what we'll do is we'll look at it today, and if they have $220,000 of income, okay, what we'll do is like, hey, you know what? They could afford to stay within the 24% tax bracket and convert $200,000. We may actually convert the full $200,000. And so here's the philosophy behind that. And here's how you play the game. So what we do is we convert $200,000. Now we're thinking about the cash flow associated with it. We need to grab $100,000 somewhere in October when he turns 59 and a half. Poof, we socked away $100,000 in a guaranteed interest that provides us no risk whatsoever for 6 months. Similarly, what we'll do is we'll calculate how much their tax will be this year as well as last year to be able to identify what's referred to as safe harbor, which is the amount of tax that you need to withhold to avoid a penalty, which in their case will almost certainly be 110% of last year. But because we would be withholding it from the Roth IRA, then what we do is, let's say hypothetically, we converted $200,000. If we need an extra, say, $5,000 to cover the amount of taxes, we take $100,000 out in October when he's 59 and a half. We take the $5,000 out in December. And if their tax bill in April is still another $30,000, we have all of that parked into guaranteed interest. Meanwhile, he's making money tax-free, guaranteed. Doesn't get any better than that.
It really doesn't. It really doesn't. Because we were able to solve the big issue that they had. We were able to optimize some other inefficiencies, I guess is the right word for it, that they didn't even realize. And
right.
And I think that's that was one of the big takeaways for them with this whole thing is that they came in. Mike says it all the time. You come in and you talk, you have one problem and it opens up a door and you explore everything else that you have going on in your financial life, and it can lead to maximizing efficiencies in other areas you wouldn't even thought about.
Correct. And that was fun. By the way, I have fun with those. When people come in with a problem and you come up with a solution, I just love it because it saves them money. It more importantly allows them to sleep at night. And, this was just really cool. And I was excited when I was telling everybody in the office, hey, you got to check this out. This is a really cool case study. And, it excites me when we can come up with these cool ideas.
Yep.
So anyway, thanks for participating.
Yeah, thanks for having me.
All right. So I hope everybody got a little something out of this. As you can tell, we enjoy what we do. And so until we see you next week, thank you for joining us and thank you for your time and have a wonderful, wonderful day.